Most people won't like hearing this, but if you can stay with me for the next 45 seconds, I'll show you why almost every new investor in 2026 is building wealth in the slowest possible way, and how to avoid becoming one of them. Here's the shocker. Over 80% of Americans who invest in ETFs still fail to build real long-term wealth, not because they chose the wrong funds, but because they built their portfolio in the wrong order. And that's the heart of today's conflict: structure versus struggle. This matters right now because we're entering a market cycle where throwing money randomly into ETFs won't cut it anymore. The gap between people who coast to financial freedom and people who fall behind is widening, and your portfolio design in 2025 to 2026 will decide which side you end up on. Today, I'm going to walk you through the exact system I use, the Core 4 Plus Turbo Engine, a simple research-backed way to build a portfolio that grows, protects, and compounds without guesswork. And if you stick with me, I'll also reveal the one asset outside the stock market that's been quietly delivering stable, high single-digit to double-digit returns, even in years when the market stumbles. Before we jump in, here's where most people mess this up. They think picking the right ETF is what creates wealth. It's not. It's how the pieces fit together. And once you understand that, the entire game changes. Let's start with the backbone, the one piece most people overlook while chasing the shiny stuff. If you're like most investors, especially in their 20s to 40s, you've probably caught yourself thinking, what's the next Tesla, the next Nvidia? It's natural, and we're drawn to the excitement of fast movers. But here's the hard truth. Building wealth through hot stocks is like buying scratch tickets. A few win big, most just lose slowly. Now, instead of gambling, I want you to imagine owning every single stock that matters in the US economy, automatically. That's what a total market ETF gives you. I call this move owning the house, not playing the slots. This is where VTI, the Vanguard Total Stock Market ETF, comes in. It holds over 3,500 US companies, large cap, mid cap, small cap, from legacy giants like Microsoft and Apple to rising stars you haven't heard of yet. It doesn't bet on who wins, it just owns the winners automatically as they rise. And historically, that strategy works. The US stock market has compounded at roughly 10% annually over the last 30 years. That means $10,000 invested and left alone becomes $67,000 without trying to pick a single stock. And what makes VTI a powerhouse for wealth building? Three things. First, it's ultra diversified. Second, it has one of the lowest expense ratios in the world, just 0.03%. That's 3 cents a year per $100 invested. And third one, it's simple. You're not logging in daily to manage it. You set it, you stay the course, and you let time and compounding do the rest. This is why in my Core 4 system, 50 to 60% of the portfolio lives here, right in this one ETF. It's the anchor, the foundation, the compounder. When people ask, Mark, if you could only own one fund forever, what would it be? The answer is this, but this is just step one. And here's where people mess up next. They build their whole portfolio around US stocks and stop. That's a massive blind spot. So next, I'm going to show you what happens when you skip global diversification and how to fix it before it costs you. Let's go to step 2. Let's clear up one of the most dangerous investing myths out there. The US always wins. It's comforting, sure, but it's simply not true. Investors who put all their money in American stocks are falling into what's known as home country bias, and it's quietly capping their wealth potential. Here's the fact. The US isn't always the top performer. Over the past few decades, there have been long stretches where countries like Japan, Germany, even Denmark outpaced the US in market returns. One of the most glaring examples, between 2002 and 2007, developed international markets nearly doubled the returns of US equities. If you skipped international exposure back then, you left serious money on the table. That's a painful miss. A full 2 times moment gone. This is why step 2 in the Core 4 strategy is what I call the global edge, and it comes from investing in developed markets outside the US. For that, I use VEA, the Vanguard FTSE Developed Markets ETF. It spreads your money across nearly 4,000 companies in countries like Japan, the UK, Canada, Australia, and more. Places with established economies, strong rule of law, and companies that dominate on a global scale. Here's the mistake most investors make. They hear go international and immediately dive into emerging markets like China, India, Brazil. That's where people mess this up. Those markets carry higher risks, political instability, and unreliable data. And yes, while they can offer big upside, They often come with gut-wrenching volatility and long flat periods. Developed markets give you a far more stable edge, and you're still getting access to powerful companies that the world runs on. SAP, Toyota, Nestle, ASML, these aren't obscure plays, they're global leaders, and you're getting them at a discount relative to US valuations. In my portfolio, I keep 20 to 25% allocated here. It's not about replacing US exposure, it's about complementing it. So when the next non-US bull run shows up, and it will, you're already there, not chasing after the fact. Now that your portfolio is diversified across borders, let's talk about stability. Because this next move could be the reason you sleep well when markets go sideways onto step 3. Here's something most investors don't realize until it's too late. Volatility doesn't just shake your portfolio, and it shakes your confidence. And when confidence breaks, people panic. They sell at the bottom, wait too long to re-enter, and sabotage years of progress in a single bad month. This is why step 3 in the Core 4 system is what I call the shock absorber. It's not flashy. It won't trend on Reddit, but it's what allows you to keep investing consistently through downturns. And for that, I use BNSD, the Vanguard Total Bond Market, ETF. Now I get it. Bonds aren't exciting, but they serve a powerful purpose. BND holds over 11,000 bonds, mostly U.S. government and high-quality corporate. No junk, no guesswork, and while the average return might seem modest, that's not the point. This isn't about growth, it's about stability. Let me give you a clear example. During the tech-heavy sell-offs of 2022 and 2023, BND helped balance out the dip in riskier parts of the portfolio. While high-growth stocks were falling double digits, BND quietly held the line and even paid out a steady 3.77% dividend, all while keeping costs ultra-low with a 0.03% expense ratio. Here's how I use it. I keep 10 to 15% of my total portfolio in bond ETFs like BND. Think of it like the suspension system on a car. You don't notice it when the road is smooth, but the moment things get bumpy, it's the reason you don't spin out. Now, coming up next is where things really get interesting. Because while stocks and bonds build the foundation, the fastest way regular folks scale their net worth, especially in their 30s and 40s, is with the asset class we're diving into next. Let's talk real estate. Let's talk about the asset class that's quietly made more everyday millionaires than just about anything else: real estate. But here's the problem. For most people, real estate feels too big, too slow, too complex. And I get it. When I first started, the idea of coming up with a down payment, managing tenants, and navigating loans was overwhelming. So most people delay it or avoid it entirely. But here's what they miss. You don't need to own a house to tap into real estate wealth. That's where VNQ comes in. Vanguard's Real Estate ETF. It gives you exposure to commercial properties, apartments, data centers, industrial warehouses, even healthcare facilities, all without lifting a hammer or dealing with plumbing calls at 2 a.m. REITs like VNQ pay out solid dividends, and because they're required by law to distribute 90% of their taxable income, they're a favorite for long-term income-focused investors. They're liquid, low-cost, and easy to buy. You just log into your brokerage account like you would for any ETF. And boom, you're a real estate investor. But let's compare that to owning physical real estate directly, because this is where the real acceleration kicks in. When you buy property, especially multi-family units, you unlock 4 huge levers that REITs can't match: leverage, tax benefits, appreciation, and inflation protection. Take leverage. You can control a $500,000 asset with as little as $17,500 down using an FHA loan. Try doing that with stocks. Then there's depreciation. The IRS lets you write off the value of the building every year, even as the actual property appreciates. And in times of inflation, guess what else rises? Rents, which means your income scales with the cost of living. Now, the trade-off? Physical real estate takes work. You need to know how to evaluate deals, manage property, or work with good operators. It's less liquid, but the upside, especially over a 10 to 20-year timeline, can be life-changing. In my portfolio, I allocate 10 to 15% toward real estate, split between VNQ and direct ownership. That way, I get both accessibility and control, and the best parts of both worlds. And here's what Wall Street doesn't want you to know. They'd rather you stay in stocks and bonds, where they earn management fees, and ignore the asset class that could scale your wealth faster than anything else if done right. But we're not done yet. Because next, I'm going to reveal the bonus layer of the Core 4 system, the piece that quietly outperformed in one of the worst markets in recent memory. Let's talk about the turbo engine of this strategy. Now that we've built a solid, diversified portfolio across U.S. stocks, international markets, bonds, and real estate, let's unlock the bonus layer. I call this the turbo engine. And it's for those who've already built a strong foundation and want to quietly accelerate their returns without playing in the casino of speculative assets. Enter private credit, one of the fastest growing corners of the alternative investment world. Here's the shock stat. Private credit is now outpacing high-yield bonds by 2 to 4 percentage points per year. That's not a fluke. It's a structural shift. As traditional banks pull back on lending, especially in a higher rate environment, private lenders are stepping in and getting paid well to do it. So what is private credit exactly? In simple terms, you're not buying stocks. You're not buying property. You're acting more like the bank, lending money to real estate developers or businesses, and in return, collecting interest. In a well-managed fund, this looks a lot like owning a bond, but with 9 to 11% annual returns instead of 3 or 4. Now let's talk risk versus reward, because this isn't for everyone. The main trade-off is liquidity. These funds usually lock up your capital for 5 to 7 years. That means you can't just click sell like you would with VTI or VNQ. But the reward? If structured properly, you're getting steady, contractual returns with far less correlation to the stock market. So here's the checklist. Who is this for? You've already built the Core 4. You don't need access to the money immediately. You understand the illiquid nature and are comfortable with longer hold periods. And most importantly, you're choosing a vetted professional fund, not just lending to your cousin's startup. Avoid platforms or deals that promise sky-high returns with no downside. If it sounds too good to be true, it probably is. Stick to firms with a long track record, transparent terms, and experienced underwriting teams. Personally, I use private credit to generate predictable yield, especially in sideways markets. And the math speaks for itself. At 11% annual returns, your money nearly doubles in 7 years, one without relying on stock market swings. But here's the key. This only makes sense after your core portfolio is in place. Think of it as fuel on top of a well-built engine, not a replacement for one. Coming up next, I'll show you exactly how to tie all of this together, what the full Core 4 Plus Turbo Engine portfolio looks like, and how you can start building it today with as little as $100 a week. Let's bring it home. Now that you've seen all the pieces, let's put this strategy together in one simple, powerful blueprint. I call it the Core 4 Plus Turbo Engine portfolio, and it's the exact system I use to build wealth with clarity, confidence, and control. Here's the model. 50 to 60% goes into VTI, your U.S. Total Market ETF. This is your growth engine, tracking thousands of American companies. 20 to 25% into VEA, developed international markets. This gives your portfolio global exposure and hedges against U.S. underperformance. 10 to 15% into BND, high-quality bonds that act as a cushion during volatility and deliver steady income. 10 to 15% into real estate, whether that's through VNQ or owning physical rental property. This adds a layer of passive income and inflation protection. Then, once those 4 are locked in, you can layer in the turbo engine with a small allocation to private credit or other income-producing alternatives. Think of this as your high-efficiency booster kicking in once your foundation is solid. What makes this work isn't just the ETFs. It's the structure, it's the balance, and it's the discipline to stick with it when markets get noisy. When you follow the Core 4 Plus Turbo Engine framework, you don't have to guess. You avoid confusion, you sidestep most of the emotional traps, and you let real compounding do the heavy lifting. And if you're thinking, this sounds great, but I don't have $10,000 sitting around to start, don't worry, because in this final section, I'm going to show you exactly what this looks like when you start with just $100 a week and why that small decision could still change your financial future forever. Let's get real for a second. You don't need to be rich to start building wealth. The truth is, most people wait far too long, thinking they need a perfect setup or a big lump sum to get going. But here's what I tell anyone just starting out. Start with what you have, not what you wish you had. Let me show you why. Scenario A. You invest just $100 a week into the Core 4 portfolio. Nothing crazy, just consistent. At a 9% average return, which is historically realistic, after 10 years you're looking at roughly $83,000. Scenario B, you wait for a better time and invest nothing. Same person, same income. One has a growing asset base and compounding confidence. The other, still stuck at the starting line. That's the realist route. It's not flashy, it's not instant, but it works. And it's exactly how people go from confused to confident, from reactive to in control. So if this video gave you clarity, give it back with a like. That helps more people find this blueprint. And I want to hear from you. Which step are you taking this week? Drop it in the comments. VTI, VEA, bonds, real estate, or something else. And remember, compound the right things. Your future self is already thanking you.